real estate is a passive income source. You can buy a single family house or 10 or 50 of them and collect monthly rents. That was my goal. I wanted to retire early. I didn't want to sit around and work a 9 to 5 until I was 65 and hoping my nest egg, right, my 401 and IRAs and all those investments would be, the goal is you hope that it's big enough that it'll last you till the end of time. When you can just replace your active income with passive income, then you don't care what size your nest egg is, right? You just create this passive income stream and you can choose to retire when you want as soon as you meet that financial freedom mark, right? When your passive income is greater than your expenses.
Yep. All right. Hello and welcome again to the Ideal Investor Show. Here we are today with an awesome guest. Flint Jamison is with us today, and he has a specialty in a certain area of real estate investing. So welcome to the show, Flint.
Thank you. It's good to be here.
Yeah, awesome. And thanks for making the time. So like I said, when we first talked before we started the recording, can you tell us a little bit, who is Flint? How did he get to what he's doing these days?
Yeah, so I'll back up way back. I'm a mechanical engineer. I went into aerospace pretty early on, and I've been there ever since. Got my MBA, went into program management. At the moment, I'm still working my day job. I am a program manager running a $150 million program modifying aircraft. But back in 2018, I got started in real estate.
Yeah, that's very cool. And before we get into the real estate, as people who come to our show know, I'm originally from Germany, but I'm also an Air Force fighter pilot retiree. So as somebody, rare treat to have somebody in the aerospace industry. Tell us, what kind of planes are you working on or modifying? Or
we could make a whole show out of this. I love geeking out about airplanes. So I started out at Boeing, commercial aircraft. I did 787 for almost 10 years.
Okay.
I was a structures engineer, so I was designing wing structure for the 787. And then I did some product development for several years after that. And then now I work for a different company. I'm in the defense side. So what we do is we take commercial aircraft or business jets, maybe single engine turboprops, and put equipment on them to do like surveillance type activities or a whole bunch of other things I can't talk about.
So is that for the government or who is flying those?
So it's both, actually. We do largely military, but to give you one example, we did things for just the state of Colorado for the wildfire support. Right. Basically, a storm rolls through, lightning strikes, and we get these two aircraft up there, and they just have these, we call them electrical optical sensors and IR cameras. It's similar to what you see on helicopters, police helicopters.
Mm-hmm. Right.
And we can fly around, survey live fires on an hourly basis or daily basis just to show how much they've grown and feed that information down to the people on the ground fighting the fire. So that's kind of a civilian approach to it.
Yeah, very cool. Yeah, I think that's a really cool field. I was in test flying in the military and I ran into that situation oftentimes that people said, so what are you working on? And I said, well, it's something pretty cool, but I can't really tell you in detail what it is. But those kind of more civilian applications, I can totally see this. I've been saying to my friends, because I'm always still from an aviation perspective interested, that I hope that the airline and aviation industry will discover Starlink pretty soon and put that on the plane so we have high-speed internet when we're flying as passengers, right? That would be kind of cool. And especially keeping in mind that if you're in an airliner at 30, 40,000 feet, you're even closer to the satellites, right? And there's no clouds typically in the way or anything. So you should have awesome connection.
Yeah.
So maybe you can pitch that to your clients that they should charge you for installing Starlink on their planes.
It's funny. I'm sure on the commercial side at Boeing, they are thinking about that. We do a ton of SATCOM communications with what we do because military has a bunch of satellites for just simple communications, right?
Yeah, absolutely. And I know OneWeb, for example, is doing something in that direction as well. There are higher orbits for their satellites and more commercial applications, and then wouldn't really lend themselves that well for like an airliner because the tangential speed is relatively high. But if you have a ground station or something like that, that could work. So I think the future for having access to information, regardless where you are, is going to improve, not just with 5G on our cell phones, but also in those circumstances in your car, in the plane, wherever you go. So I think you have a pretty safe job there, Flint.
Yeah.
Cool. Well, so you said you did that, you're still doing that, and then you got into real estate. And I know from your bio that you, I think, started out with renovating a duplex. And how did you go from there?
Yeah. So let me back up a little bit more. Probably your listeners want to know why real estate, right? And the whole goal is
Sure.
real estate is a passive income source, right?
Right.
You can buy a single family house or 10 or 50 of them and collect monthly rents. And that was my goal. I wanted to retire early. I didn't want to sit around and work a 9 to 5 until I was 65 and hoping my nest egg, right, my 401 and IRAs and all those investments would be, I mean, the goal is you hope that it's big enough that it'll last you till the end of time. When you can just replace your active income with passive income, then you don't care what size your nest egg is, right? You just create this passive income stream and you can choose to retire when you want as soon as you meet that financial freedom mark, right? When your passive income is greater than your expenses.
Yeah, exactly. Yeah,
So,
we call that the time freedom point,
yep.
where that number is exceeding your expenses, like you just said. And then you have the freedom to say, okay, do I love my job and keep doing it? Or do I take the freedom to do whatever I like and don't do that job?
Yeah, and a lot of people in this, it's not like we go sit on a beach when we hit that time freedom point, right? Because honestly, a beach is pretty boring to sit on 100% of time. So we typically turn around and give back to communities and yeah, travel the world, show the kids amazing things around the world is kind of my goal.
Yeah, absolutely. I mean, the terminology that I typically use, regardless whether somebody just recently came to us or heard us on the podcast or, something like that, to really say, okay, think about in your mind, what are you really passionate about? And that can pretty much be anything. And most people cannot allow or afford for themselves to constantly all day long live their passion.
Yep.
Right. And that can be something charitable. It can be like, I love to paint, or I love to hike, or I love to travel, or whatever it might be that you're passionate about. That's the freedom that you then have when you reach that time freedom point to live into that passion. It's not being passive and not doing anything anymore, like you said. It's
Right.
really exploring that passion to the fullest extent. And this, I think, is very important, without having to worry how to pay your bills.
Correct.
Right?
Yeah.
Because I think the freedom is not just to have the freedom to make those decisions. The freedom is also to get away from under this burden of how do I get enough money in the door to pay my bill.
Yep. Exactly.
Yep. So I think we are very aligned with that, and you're just using a different set of ways to invest. Can you describe a little bit how you got there?
Yeah. So I started out as most people do in real estate is just go find a single family home. I decided I wanted to leapfrog the single family and do a duplex, get as
Okay.
many doors as possible. I did the BRRRR strategy, the buy, rehab, rent, refinance, repeat. It was so I bought this place for $80,000. It was essentially a wholesale unit. It was distressed, it needed renovated. I put money into it. I had to put more money into it, and it took longer to renovate, right? The standard flip issues
Right.
that
Right.
happen, right?
Yep.
Cost more and takes longer. But then we got tenants in, and I've had it ever since 2018. I've had the same tenants there. So it's in large part been a good cash flow machine. But I realized the cash flow isn't going to get me there, even if I go buy 50 doors and do that same thing over again. The path to my time freedom point or financial freedom point was going to be a very long, arduous road. So serendipitously, I was educating myself via podcast mostly while I walked my dog.
Right.
And I came across a podcast that was talking about multifamily syndication. So buying apartment buildings with a bunch of like-minded investors. And I dove straight in. It seems to be where most people go when looking to scale, right? You start with a single family. A lot of people start flipping after single family. They may go duplex, quadplex, maybe wholesale. There's kind of this path where people take, and then eventually they end up in these multifamily syndications. And that's like the holy land for real estate investments. It's not only the most stable, it actually gives you the highest returns. It is the most efficient path to financial freedom. And I'm thankful that I just happened across a podcast talking about it, because I totally leapfrogged all those other midpoints and went straight from a single duplex to doing multifamily.
Okay, yeah, that sounds very interesting. Now, for our audience, can you explain a little bit how somebody that, let's say somebody had $50,000 and they were making basically the choice, okay, I could use $50,000 and get myself like a $250,000 residential property, or I can give $50,000 into a Flint's deal with the indication. How does somebody who does basically the syndication route, how do they actually make money?
Yeah, so there's two sides to this story. There's the limited partners, which are the true passive investors, and they are the financial force behind it. If you are someone who is thinking about you wanting to get into real estate, but you know you don't want to deal with buying a house, we all know what it takes to buy a house. It's painful and it takes a lot of money, and it likely takes more than $50,000. What multifamily syndications do is a syndication is a group of people combining resources to accomplish more than what one individual can. So a whole bunch of people with 50,000, 100,000, you may get a $500,000 investor. You can go buy a $15 million apartment complex as a group. The limited partners, like I said, are the financial force behind it. They put the money forward. There's the general partners, which is a smaller team of people that do all the sweat equity. They find the deal, they put the business plan together, get the lending, right? All the due diligence, property management, they manage the asset throughout. They do all the hard work. They get a piece of that pie through sweat equity. And that's kind of where I'm going. I'm general partner and I'm limited partner on a bunch of other deals. But the cool thing for the limited partners is you can get in on real estate for $50,000, own a share of it. You actually get equity, which this is key because you've heard a lot about REITs, the real estate investment trusts through Fidelity or whoever, right? It's essentially a real estate fund. If you invest through a syndication, you actually get a percent of equity, meaning you get the tax depreciation on the back end. You get all of the benefits of owning real estate without actually having to do any of the work. The general partnership side does the work with the property managers. So you can either go buy a house and manage it yourself, buy a house, get a property manager to manage it, but there's still a lot of work. Me owning this duplex, there's still a fair amount of work. I have to do the accounting. I still have to do a lot of the tax work on the back end owning a single family. With this syndication, it is truly passive. You find a team like myself, you find a deal that you like, you invest into it, and then you sit back and you collect money. We give distributions quarterly. At the end of the year, we'll give you a K-1 tax statement, which you just give to your accountant. It's super straightforward and simple. You get all the benefits of real estate without having to do much.
Okay, yeah, that's very cool. Now, can you say, in like you gave the example for that apartment complex, how many people would somebody have to imagine to be in that group of general partner?
So this recent one we just did, the general partnerships can get quite a few people. We just closed on a 100 unit in Georgia. It was a $14 million unit. We had to raise $14.5 million. There is what we call the lead sponsors. There's, going off the top of my head, 5 lead sponsors that are really on the ground doing a majority of the work.
Mm-hmm.
But to raise $4.5 million, those 4 or 5 people may not be able to pull from their investor pool that much money. So they bring in what we call co-sponsors, and it's just capital raisers. So there's people like myself that I can bring capital to the deal, and I get a portion of equity out of bringing a whole bunch of investors to it.
So would you say like 5 to 10 is like...
On this one, I think between the lead sponsors and co-sponsors, there's probably 15 to 20 of us. I mean, this deal was very unique in that fact that there was a lot of capital raisers that were involved in it. But in general, I would say 5 to 10 is the typical general partnership team.
Okay, and then you mentioned earlier that those 5 to 10, maybe sometimes it's 15 people, they basically, their part is the work, and the work is basically the sweat equity. What does that mean? Like, how much do they get a portion of the property for their work?
Yeah.
It's basically financed by the limited partners and putting their money in as basically their contribution, while the other people put their work in and get...
Yeah. So the general partnership usually has about 10% of the financial stake into it. But the way this goes, so we'll take the single family example again. When you buy a single family home, you're likely to leverage it. So you're going to go get a mortgage on it,
Totally,
pay
yeah.
20% down. We do the exact same thing with apartments. We will go get lending, whether it's your institutional lending, the Fannie or Freddie, or we go get private loans. There is actually a lot of opportunities for private lending. There's a ton of banks and a ton of private lenders out there that really, really love apartments, multifamily, and they come into our deals. So they will fund the 70 to 80% of the deal.
Okay.
And then the limited partners is where we fill the gap. So that's where the limited partners come in with their finances. To simplify this down, the limited partner to general partner equity split is 70-30. So the limited partners come and they get to split 70% of that property. Now, every deal is slightly different. It could be an 80-20 split depending on
Right.
how that deal works. But yeah, you could have 50 investors in on that 70% of the equity. And then there's, call it 15 team members on the general partnership side who split that 30%.
Right, absolutely. And thank you for explaining that to our audience. Now, the other part that I think is probably interesting to realize, because when people, look at Ideal Wealth Grower and our podcast and Ideal Investor Journey and so forth, you're absolutely right that we are basically doing the more traditional. We're buying a single family or duplex, triplex, but basically forever, and benefit from both the appreciation and a cash flow. And you're right, you could argue it hasn't the same punch, so to speak, like a syndication. Now, one distinction, at least I believe I understand, is that you don't get involved in this limited partnership and then you have it for 20 years. So can you say a little bit of what the
Correct.
time horizons are and how this
Yeah.
works in that way?
I'm glad you brought this up. So the most typical business plan that you'll see out there is a 5-year plan. It could be 5 to 7. The goal is we always buy a underperforming asset, whether that's a 30-year-old apartment complex that's never been updated and it needs a refresh, kind of like a house flip. You could buy a mom and pop operated place that they just do not push rents. They have horrible tenants. The rents are
Yeah.
exceptionally low.
Right.
And like there's deferred maintenance, right? Those are the type of places we take over. So the cool thing here is when we take those over, similar to a flip, you kind of do a forced appreciation. It's not natural appreciation. The value goes up over time. I mean, we hope for that too, but that's just icing on the cake, because we can actually calculate if we go in there, renovate all these units. We know the submarket, there could be a hospital and school nearby, and we know exactly the clientele we're going to be marketing to. We know exactly what the rents we can get to by the comps in the area. We can truly calculate how we can take the value of a underperforming apartment complex and how to get it to maximizing, not only in rents and additional fees, maybe pet fees. We can add additional amenities. We can decrease expenses. There are so many different threads we can pull to get the net operating income of an apartment complex up. And the goal is we do it within 5 years, and we typically target a 15% internal rate of return or average annual return over those 5 years.
Yeah, that's very cool. And I mean, I'm always trying to explain when we compare these different approaches to each other. When somebody says forced appreciation, to say, okay, well, imagine a 100-unit complex and the average, just for the easy calculation, for each unit is $1,000 per month in rent income, and it's 100% occupied all the time, just to make it easy. And then over time, people move out, and every time somebody moves out, Flint and his team come in and renovate it, and then they can rent it for $1,500. So that's obviously 30% or a third more, 33% more. But then I think the way I understand it, and correct me if I'm wrong about that, Flint, ultimately, if you say, okay, these 100 units now over time are all renovated and they're all making 1,500 and they're always 100% occupied. So the whole thing is obviously at least 33% worth more than it was when you first got into it. And hopefully it didn't cost you the equivalent of like $500 a month or so in paying for the renovation, right? Is that kind of like the way to do the forced?
Yes, that's a simplified version of it, but it's actually not too complex. We have big spreadsheets that we build these tools, and we can put all of the factors in. What are the costs to operate it? Put the loan in there, right?
Right, yeah.
And then how to raise rents year over year. And at the end, the cool thing about commercial real estate is it's not like a single family home. When you go to sell your single family home, the value is based on what your neighbor sold for. Whereas commercial property, it's not necessarily that. The property is rated on the revenue it makes, on the net operating income. And this is the cool thing, is because you can actually calculate what your projected revenues are going to be. And you can even do a sensitivity analysis on it. You don't have to worry necessarily about what the market's going to do, because we know what we can achieve by renovating and getting rent bumps. Then we in turn calculate the value it will be in 5 years.
Right. Now, if you go and say, okay, we'll take this example where you said, okay, we had a $14 million deal and we did our thing for 5 years. And now let's just, for sake of argument, say we want to sell it for $20 million. If there are changes in the economy or changes like we hear, everybody that listens to the news and is interested in real estate and financing knows, okay, the Fed is going to increase rates, the loan interest rate's going to go up, the economy or the financial markets might get volatile. Is it hard to get to the goal sale price at the end, or are you worried about that? Or would that be something that you would have to address if somebody were to say, well, what happens if all these horror scenarios that the media
Yep.
is making us believe are going to happen, if they were, or at least some of them were to happen? How does that impact the syndication deal?
Yeah, so we're always looking, that's where the sensitivity analysis comes in. One, we choose a market that isn't just going to disappear. Like Augusta, Georgia, where we bought this place, that is definitely a thriving city in this very particular area we bought in. It has a lot of big businesses in the area. So you find a stable market, even in a downturn. It's not like people are going to disappear. If we look back in the past, so one thing we do is multifamily apartment buildings is a human need, right? We
Yeah,
need shelter. That's
right,
not going to go away.
right.
Investing in retail space, we've learned through COVID, is now, or office space, right? Now we
Right.
know, oh, there's this thing that we didn't know about in
Yeah, but that's
2019.
not in Maslow's pyramid. Retail space doesn't exist. He only talks about shelter, right?
Yeah. Self storage is actually really exciting too. But
True.
anyway,
Yeah.
it's a human need. So you will always have people. You flash back to 2008 when there was the housing crisis. Well, there was actually a lot of people who had to move out of their houses. And if they had to downsize, they
Yeah,
didn't go live in a
obviously.
van down by the river. Where'd they go? Apartment
Yeah,
complexes.
totally. Yeah, yeah,
And
exactly.
when things are good, I mean, you still have a younger population that's constantly needing to move into apartments. You have three different classes of apartments: class A, B, and C. So, C being your lowest level, lower income, less desirable places. We
Right.
actually like to buy class C that are in up and coming areas that we can turn into class Bs. There's a lot of things we can do, but if we play in the class B realm, we can turn them into class A's. But as I'm saying, as the economy goes up and down, your tenants will also migrate between classes. So as the economy increases or costs increase, you may have a bunch of tenants going from A to B's because they can no longer afford the rents in the
Right. Yeah,
A's.
totally.
And on the flip side, you can have tenants migrating from C to B's and B's to A's.
Yeah, what I was getting at is, I'm assuming that any time when you guys, for example, analyze a deal, or if, you get to the end of the expected period, 5, 6 years into a deal, that anybody who would be on the purchasing end and getting like a B or maybe even an A class deal, they wouldn't buy it outright cash, right? They would have to look into financing as well. And I'm just wondering, with all this fear mongering about rates going up and stuff like that,
Yep.
if that could make it hard in the future. Because I know that people, in our system with the idea wealth grower, people always ask what are the risks and what do we need to anticipate. And it's
Yep.
not necessarily how likely, is it definitely going to happen? Nobody can predict that. But what are the things that people should be aware of? And I think
Yeah.
this increased interest rate environment, and therefore how much actually does it perform after you went through your cycle and then looking for a buyer so you can basically exit the deal. I'm curious kind of how you address that.
This is all very deal dependent, but I'll give you some examples. One thing that a lot of syndicators are doing are leaving what we call meat on the bone. So maybe we renovate half of the units to a medium grade and we renovate half of them to the top notch apartments and get max rents out. And
Okay.
in 5 years, when the interest rates go up, we don't necessarily just have a turnkey apartment that's fully renovated and there's no meat left on the bone for forced appreciation. We have left half the apartment complex to have some rent growths. And it's possible someone can come in and say, hey, yeah, we have not only proven that you can bump the rest of the apartments up and get these proven rental rates, they might be able to show a business case that that works. So that's one thing we a lot of times leave meat on the bone for the next guy to come in and make more money with forced appreciation. There's other aspects where if we need to ride it out for the long haul for whatever reason, we can do a cash out refi because we have already put value into it. The lenders will come in and say, yeah, cool, you guys are operating with a much higher NOI. You are now worth this much more. We can do a cash out refi. And when we do those, which those happen quite often, we give the investors say 75% of their original investment back. So you put in 100 and 3 years later we'll give you 75,000 of that back. You can turn around, reinvest that somewhere else while you're still writing out the deal with the same amount of equity ownership. And if we, for whatever reason, just have to write it to 7 years until the market changes or interest rates come back down, you still are taking advantage of those cash flows. So there could be 20 different scenarios we could go through, but we do get pretty creative. And in this environment, we make sure we underwrite super conservative. We don't go into details with slim margins because we're getting into apartment buildings, and it's not if something happens, it's always when something happens. And so we underwrite conservatively to have that buffer to cover ourselves in those rough times when they happen.
Yeah, that's cool. And I think you already that would have been part of my next question, but you already covered that basically for, how does the exit look like? I think you mentioned one scenario as you just described it, with a little bit of a positive twist. Somebody maybe got into a deal with you 3 years ago. They have maybe a year or two to go. If everything works normal, you find a buyer, the buyer buys the property, basically now you have a chunk of money. What does that mean for somebody who participated as a limited partner in a syndication? Do you always work on transitioning them over into the next deal, or
Yes,
how does that?
absolutely. Okay, so I talked about this tax depreciation. Now to expand on that a bit more, this year in 2022 alone, we can depreciate the entirety of the asset, 100% of the asset in that first year. So you get this huge paper loss when you file your taxes. However, when we go to sell the deal, you have a big capital gains income coming in. And a lot of people have that money in there just to go for the long haul. So typically they turn it around, they'll put it in another deal, then you get another big tax depreciation on that next purchase. So people are kind of riding this wave of, if I continue to just reinvest it, I'm still getting cash flows, quarterly cash flows, but I'm also trying to protect myself from a big tax hit by dropping it right back into something else.
And so the longer term investor, would it be fair to say they're either going from smaller to larger deals, or from just one being invested in one deal, then in two, and then maybe in four, and so forth?
Yeah, there's a couple different ways you can play it. We like to do diversification, where you can diversify yourself not only in multifamily assets, like I'm going to invest in a Class B here in Augusta, Texas, or in Augusta, Georgia, and then I'm going to buy a Class A in Dallas, Fort Worth, right? A lot of people diversify themselves across the country, diversify across different markets. And then there's a snowball effect that happens when you start investing. You put 50K in this year. If you can afford to put another 50K in next year, eventually that money starts coming back to you. And that money may come back sooner because a deal may close sooner. If we meet that average 15% IRR over 5 years, if we meet that equivalent in 3 years, which is like 35% return, we may sell because we can get out of the deal sooner. You get your money back sooner, you put it in another deal, or there's a cash out refi event. You take most of that money back already and dump it in another deal. So a lot of people will end up just starting to put their monies in a bunch of deals. And then I don't like having my money distributed everywhere, right? I don't want to have 20 different opportunities. So I'll start putting bigger chunks, right? We have people that are $500,000 investors. There's $1 million investors that'll just buy into a really large deal with $1 million.
Yeah, that makes sense. And thank you for describing that, because I think that gives people an idea, how does this look like, and how long is the money in there? What is my ownership? And then also, what can I expect to get out of it when I'm selecting this kind of investing? So I want to really thank you for that. So coming kind of like towards the end of the show, and I told you before we even hit record, there are always like two kind of somewhat surprise questions, but I asked all of them to every one of our guests. The first one is, and it doesn't have anything to do necessarily with real estate, but if you had free choice to meet somebody that you always wanted to meet, either current or maybe even historically, who would that be and why?
Let's stick with the aerospace thing from
Okay.
before.
Yeah.
I would really love to go back to the 1960s during the Saturn days of Saturn 5 days, write missions to the moon and talk to some of those first astronauts, specifically Neil Armstrong himself. He's a very unique character. He was very calm. He's not really outspoken. It would be fun to just get him isolated in a coffee shop and pull as much out of his brain that I could.
Yeah, actually, I want to ask you real quick, and this is something that listeners who aren't that much into aerospace and space have to look up, because I'm not going to explain it. But Are you excited about Polaris?
Polaris, the
Recently announced 3-mission Polaris thing that Isaac Man is going to be on.
oh, I'm not as much up to date on some of these.
Just shot into my mind because you said Apollo, right? Like in parallel to Apollo, for the nerds, there was also
Yeah.
something called Gemini, which
Yep.
was basically the program where they tested in kind of semi-low Earth to medium Earth orbit all the systems, like leaving the capsule and survival systems and stuff. When you look at that stuff, what they actually did and what the capsules look like and stuff, they're totally cowboy jockeys, crazy people to even do that and try that.
Yes.
But it was
Yes.
basically necessary to ever have a chance to fly to the moon and get out of the Eagle and go actually and jump on the moon like Armstrong ultimately did, right? And so now, just about a week or two ago, Jared Isaacman, the guy who was basically the mission commander on the SpaceX mission for the Inspiration 4,
Yep.
announced together with SpaceX that they're going to do 3 missions. And the first one is called Polaris Dawn. And it's basically, in a way, in modern times, 21st century, doing what the Gemini people did.
Yeah, and then ultimately Mars, right, through
What, right. Yeah,
SpaceX.
he wants to be
Yeah.
the first human to be on a spaceship from SpaceX. So I guess nobody knows how long it's going to take before that's actually going to happen. But Starship is such a amazing project if it actually works out. It's kind of like
Yeah.
the Apollo of the 21st century, I would say.
Right. It is just absolutely massive.
Yeah.
Yeah, I hadn't heard that recent news on
Yeah,
Polaris.
so
That's
maybe
cool.
this is something, that you and I can nerd out on. For Polaris Dawn is the first mission that they actually gonna have. And it's supposed
That's
to be by the
exciting.
end of this year, so we're not talking way into the future, right? So
Yeah, I mean their capsule's pretty mature, so
yeah, true,
that's
true.
cool.
Yeah. I don't want to ask you as a former Boeing guy if you think Starliner will ever make it off the ground. So
Yeah, there's now a documentary out there about Boeing and how it's
yeah. I haven't seen it
not.
yet. I heard some comments about it, also about 737, So I was kind of almost tempted to ask you if you worked on the 787 battery, but I stayed away.
Uh, I did not work the battery, but I know a lot of friends who got, we call it the Tiger Team, the people
Yeah.
that get sucked in to solve the problem, and I know how the problem was solved and all the issues behind it.
Yeah, I'm sure. Okay, so the other question, the other kind of surprise, unless you have listened to lots of our podcast, question is, if you had a time machine, Flint, where would you go, forward, backward, when you can go anywhere, and why would you go there?
It's funny. I kind of have two answers. One, I would like to go forward just because I really love like space travel, and if you go
Yeah.
forward in the future, it's just going to be easier and easier to get to do that. But then in history, yeah, there's talking to the Apollo astronauts, but you go back further, I think it would be really cool to see dinosaurs just in real life, right? Because it's just it's so hard to imagine. All we see is bones, and now scientists think they have feathers, right? Let's just go back there and see the enormous beings that were there at that time.
Yeah, I think that's fascinating. And I mean, the going forward, I guess, is, people like you and me who are basically willing to be in aerospace and be a little bit daredevil, but there is still always this safety aspect, right? Even I know Boeing or any entity that I've ever come across that has to do with aerospace, safety is always number one, right? So to be able to say, well, I would like to go like to maybe 2045, but because I'm assuming that
Yeah,
it's going to be safe to go to Mars then. So
uh, I that's a great question. It's funny, we joked at Boeing that we couldn't put a new technology on an airplane unless it's flown for 10 years or something. It's just it takes the 787 as we advertise it is like state of the art technology, and it is state of the art for commercial aircraft, but all of that technology on there, I mean, it was developed in the 70s and 80s, and we're just finally now getting qualified to fly on commercial aircraft. We just now got all of the we call it the allowables. We have to do just billions of dollars of testing to get the data we need in order to justify putting it on an aircraft to prove that it is safe. So, yeah.
I can totally relate. I mean, the thing is, we started this conversation and it sounds like we're finishing this conversation with you can talk about things without really getting very specific. I mentioned in the beginning that part of my Air Force career was in test flying.
Yeah.
And before I came over here to the US in a role as like an exchange officer before that, I was involved in an electronic warfare system that had basically a quad chip assembly of Pentium 5 processors when people were basically raving about their Pentium 2 and Pentium 3 in commercial laptops, right? And I couldn't say what it is and how it can work like 4 at a time. But the capability in the end was that within, while going anywhere with 600 knots. Any aviator knows how fast that is, like basically 10 miles a minute. At that speed, within 3 seconds, to analyze through a computer analysis calculation of phased array shift where something on the ground is located within 3 feet. Right. And
Yeah.
you couldn't, even if you wanted to explain that to somebody, people would literally claim that those kind of computer capabilities just don't exist. They literally flat out would have denied that that exists. And we were using it, we were developing it, we were integrating it, right? So that's the other kind of exciting part, that there is stuff out there that not necessarily everybody is aware of. And I don't know how far it's gone by now, but
Yeah.
when people
You
say,
just,
okay, this kind
you got to
of
project it forward.
yeah, no, I mean, I'm oftentimes saying this, we have fear mongers out there, but I'm excited when somebody like Elon Musk says one of the biggest things we're working on is Tesla bot. I'm kind of back in that frame of mind to say, wow, imagine what that could do, right? Even if I don't know all the detailed technology that goes into it, but it's amazing what's possible.
Yeah, absolutely. It is fun to see. I mean, sometimes we put standard technology on airplanes and use it in a very unique way to get unique answers.
Yeah, and that's actually, I mean, one of the things I dug a little bit into how SpaceX actually became what it is and this whole like propulsion landing and stuff like that. And one of the big things is that they were just saying, okay, because we're not necessarily falling under the same exact regulatory requirements, we are going to see if regular stuff that is approved for industry but not necessarily approved for space can work it and put things together, and didn't do the regular NASA space testing. And the acceleration in development is just mind-boggling how much faster they could do things because they're a private entity that was willing to say,
Yeah.
okay, we shield a computer chip and let it do the calculations. Just because it's not NASA approved doesn't mean it's going to fall apart. And case after case after case after case, they were proven right.
Yep.
All right, but enough about that kind of cool stuff. Before we close, Flint, how can people who kind of got the bug now and say, wow, this is kind of cool, I can put money in with Flint and join a crew and invest and not have to wait for 20 or 30 years to retire? I can maybe actually get to a point sooner than Axel in his approach, which doesn't make it better or worse, it's just different. How can they get a hold of you?
Yeah. So the best path is just to go to vestuscapital.com. That's VESTUS capital.com. And connect with me. So we take accredited investors. We also take non-accredited investors for some deals as well. You got to get on the phone with me so you can find me there.
Yeah, that's very good. And we will get the exact right email and the website and all that stuff in the show notes so people can actually get in touch with you and maybe they become syndicating or syndicate investors.
Perfect.
All right. With that
Thank you.
being said, Flint, I want to thank you for being on the show, spending your valuable time. Any last words?
I enjoyed being here, and I always love talking about aerospace.
Yeah,
And
absolutely.
real
Me
estate.
too. As people that listen to us will find, like 30% of this real estate show has been on aerospace today, but I think that's okay. Well, thanks again for being here.
Yeah.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.